Hey guys, it's Jordan DeYoung here, and today I want to really walk you through how critical your borrowing capacity is. It's something that took me quite a while to sort of figure out how it impacts things and maneuvers around, and what is my maximum borrowing capacity. I thought at one point in time I could just keep on buying infinity properties as long as they were paying for themselves, and the banks would keep lending me money. But it does have a huge impact on the overall strategy of your greater portfolio. So we're over here on the Game Plans platform. We're using a test user, and this test user earns 180K per annum between two people, so just above the Australian average income at the moment. They're saving about $5,000 per month, which again is quite high, but we're sort of looking at some working professionals being able to achieve these sorts of goals. We've got 150K worth of savings at the bank at the moment, starting from today, and we're using all these numbers to sort of move forward. So some of these assumptions that we've got up the top here too, being really conservative, the numbers that we're looking at moving forward. And it's so important to be conservative when you start chucking in things like 10% capital growth rate or 6% rental yield on every single purchase. You can blow out the numbers and they're not going to make sense. So, or be actual. They'll make sense, but they won't be actuals. So what we've capped here is 5% capital growth rate moving forward into the future. We've got a 4% rental yield on entry, and then that's only going to increase at 2.5% per annum moving forward. So it's not just going to be a straight 4% every year moving forward. We've got a whole bunch of other assumptions that are in here at the moment, and I go into much more detail on the platform about how these work. Feel free to jump in and have a look. There's just one other really critical assumption that I've got here, and that's the borrowing capacity. So at the moment, I've set this at 1,000 times income. So, we've pretty much got infinity borrow capacity. We can borrow what we want. All we're sort of waiting for is when we have either enough in savings, number one, or number two, borrowable equity within the portfolio to be able to use as deposits to get into subsequent purchases. So we're going to walk through this base scenario first, which is going to take us through, okay, well, if we had an infinity borrowing capacity, this is how long it would take to reach our goals. We're starting with 0 properties in the portfolio today, 100K worth of passive income throughout the family. We've got 150K worth of savings at the moment, and our target goal is 150K per annum. Now, I've got the Game Plans algorithm turned on in the background, and what that's going to do is map out the best time to do these purchases based on borrowable equity, the types of purchases that we're going out for, and the savings as well. So combining savings and borrowable equity to match the type of purchase that we're looking for. And then it's going to be really conservative in terms of let's only do the certain amount of purchases that we need to be able to achieve that goal of receiving 150K of passive income per annum. Now, first couple of things here, we've got our first chart, which is the buckets chart, and this is just a simple breakdown of expenses versus lifestyle versus savings. So they're saving around $5,000 per month, which again is a little bit high, but something that most people can do on that sort of income. We've got our offset and annual spends chart. So this is just, sort of seeing how much offset that we've got at each point in time. We're doing another purchase here in 2026, and that's why our savings comes down, because we're using some of that as deposit to get into that savings. So that's going to be over the next 10-year time horizon. We've got our manually entered spends, which just breaks down our purchases over multiple years. Our property summary. So this is going to list out all the purchases that we're doing along the way, our equity position and where our savings will be and property value will be at that point in time. Passive income target, which is when we're about to hit those passive income targets. And then the other thing to note here is this borrowing capacity. So essentially our borrowing capacity today is $14 million, which no one has on 180K passive income, but that's the first scenario that we're working through, is just infinity borrowing capacity. We're just utilizing how much savings and borrowable equity we have to do subsequent purchases. So what I'm seeing here is multiple purchases that the algorithm have plugged in. We've got this first purchase this year at $625,000. So that's essentially just using the savings that we have today to do that purchase. So we've got one purchase here, and then we're not purchasing again until 2026, but we're buying a $1.1 million property. Now, that's because what it's doing is it's still going for a growth-focused property, so we want to get into a really good fundamental asset here. And it's waiting till we've got enough savings plus enough borrowable equity from that first purchase to be able to get into that property. So 5 years here until we get into that next purchase. And then we've got 1, 2, 3, 4 more purchases over the next 5 years. So we're waiting a little bit to get into a good growth asset, and then we go super aggressive after that. Maximum of 6 purchases within the portfolio. But what you can see here is all these numbers are around that sort of 600K mark. So 2028, 2029, 2030, 2031 is our final purchase. That's what the algorithm's plugging in based on how much savings we're going to have in every year to be able to achieve that. So that's making sure that we never get below our minimum safety net or never get below, $0 within the savings. So just to clarify, what that means is in our offset and annual spends chart, we've got this little yellow dotted line at the bottom here, and that's our minimum safety net. And that's just saying, well, based on our expenses per month, that's the amount that we need in our savings never to be able to go below. So it's around sort of 25 grand probably for this user specifically. So the goal of the algorithm, and you can see here we've got investment purchase here, investment purchase in 2026, then another investment purchase, another investment purchase, another investment purchase, another investment purchase, 2031. And so the goal of this is to never drop below that minimum safety net. We always know that we're going to have about 100K worth of savings in our savings account. For the worst case scenario, in case someone loses their job or something like that, changes to income or whatever it might be, right? So 6 purchases over the next 10 years. In terms of our overall portfolio, we get to a total market value of $5 million over that time. We'd have a total debt of $3.8 million, and then we slowly pay that off down to about $800K. Over a 30-year time horizon, we hit $1.1 million within the portfolio, which is great. And then we do end up hitting this passive income target of $150K over time. And there's a couple of key things here that I really want to spit out for you guys just to show you. So we're accumulating those purchases along the way. We're still saying passive income all the way through. Once we finish acquisition, we get to a total passive income of $51,000 in 2038. And then when we roll over to principal and interest repayments instead of interest only. So you can see we're refinancing here, interest only, interest only, interest only. Rolling over to P&I, we actually have about $400 worth of passive income making principal and interest repayments. And then we essentially compound that. So now we're making those repayments. There's no additional costs that we've got to pay, and we end up hitting that passive income of $150K over 2051. Now, we could hit that goal sooner of that passive income target if we did more purchases, right? But what the algorithm does is say, okay, well, what's the minimum amount of purchases or the minimum total that we need in our portfolio to be able to achieve that end goal of passive income of $150K? So being quite conservative, especially with those earlier assumptions I mentioned before, like 5% growth rate, 4% rental yield. So 6 purchases over 10 years to be able to do that. Key thing to watch here is our borrowing capacity chart. What I'm going to do now is change that 1,000 times income to just 6 times income, which is the general rule of thumb for borrowing capacities today. Now I know APRA can step in and change these things, and banks can make alternatives and all that sort of stuff. But 6 times income is a really good rule of thumb of how much you can potentially borrow if you do want to be conservative. Now, what we're going to see here, so same scenario, still got 180K worth of passive income, still starting with 150K in savings at the bank, still saving $5,000 a month. Right? We've still got that first purchase in today at 625, but now what the algorithm is saying, well, we're going to do another purchase in 2025, so we don't have infinity borrowing capacity, right? We're only going to be borrowing as much as we can. So in 2025, we're making another purchase of 760K. Then we're not making our third purchase till 2031 at 670K. Now, if you recall, that's when we were doing our final purchase with an infinity borrowing capacity. Then we have to wait another 5 years or 6 years till 2037 to do another purchase at 700K. And then we're waiting another 6 years again or 5 years again to do that final purchase in 2042 of 800K. So we've essentially gone from our final purchase in 2031 to our final purchase in 2042 being actually using that borrowing capacity number being factored in. So we've got 1, 2, 3, 4, 5 purchases in total. So 5 purchases in total instead of 6, but it's over a much longer term time period. Our equity position, I'll take you to the fun part. So this is the borrowing capacity chart that we were seeing before. Now, if you can recall, we had a total maximum borrowing capacity of 14 million this year. Now, if we actually take the actual, we've only got a borrowing capacity of 880K this year. So we're not utilizing that total borrowing capacity this year because we've only got limited amount of savings to be able to utilize that. But it's not until 2025 until we can have that borrowing capacity again, with the savings available to make that purchase. So if you remember before, we were buying like a $1.1 million purchase. Now it's only a 700K purchase because that's all we can afford within our borrowing capacity. another one again in 2031, another one again in 2037, another one again in 2042, and then we end up paying our debt down to around 300K in 2050. So only 5 purchases, but it's going to take us 20 years to accumulate those purchases. It's not going to take us 10 years. So if anyone's sort of saying to you that you can sort of buy infinity purchases, we're going to buy 10 properties over 10 years or 5 properties in the next 5 years, it's not realistic. Those borrowing capacities really do come into factor. They do come into consideration. It's going to have a limiting factor on things. Now, our total market value at that point in time is going to be around $6 million based on a 5% compound growth rate. And then our offset account is going to be around that $2.1 million. So that's our debt. Our total debt is going to be about 2.1. Pay that down to about 300K that we saw before. So that's how critical your borrowing capacity is. You can see here from this borrowing capacity chart, we're touching that borrowing capacity, maximum borrowing capacity every single year. Now, our borrowing capacity is increasing when we're doing those purchases. As you can see, when we do a purchase, the borrowing capacity increases a little bit, but it doesn't increase that significantly that you're going to be able to keep borrowing, and keep borrowing. It's going to take time to get to that point eventually. And then we're still hitting that passive income of 150K. It's just taking us 20 years to get there, or 20 years to do those purchases, I should say, rather than 10 years within infinity borrowing capacity. So again, we're accumulating. We stay interest only until 2042. If we roll over to P&I, we go from 61,000 down to 31,000. So we're copping 30 grand a year and paying principal repayments on the loans at that point in time. And then from there, we end up compounding and hit that target passive income of 150K within 2051. Again, you could probably hit that passive income target a little bit sooner if you did a few more purchases. But what the algorithm does on the back end is say, okay, well, based on the minimum amount that we need to purchase to get there, this is what we're doing here. So that's all really it for today, guys. I just want to walk you through how critical your borrowing capacity is and how much of an impact it's going to take on your property journey. Now, these are using really conservative numbers. If you were to ramp up your growth rate to, 6.8%, which has been the Australian average over the last 25 years, and I hate saying that and hate using that number because there's markets within markets and suburbs within markets. And let's just say, for argument's sake, you increased your rental yield up to 5% or something like that. Obviously, you can't get that in certain markets, but there's other markets that you can get that from. So when you start to really ramp up these numbers, that's when you can start to achieve some better results. So now we're only doing 3 purchases, one this year, one in 2031 or 2030, and then the last one in 2040. So we're 2 years. We're only doing 3 purchases in total, and we're essentially doing that final purchase 2 years prior. So we were 2042, now we're in 2040, and we are hitting that passive income a little bit earlier. So there you go, guys. I think that gives you a really clear picture of how different assumptions can really factor in and play around things. When you do start to ramp up that growth rate and that rental yield, you can get some better results, which in an ideal world, this is what you would want out of a property investment journey. I just think the biggest critical thing for today was that borrowing capacity. With an infinity borrowing capacity, we can kind of buy what we want as soon as we've got savings. We can achieve our goals, or we can finish our acquisition stage over 10 years. But when we do actually factor in that borrowing capacity, which is 6 times income, it's going to take us another 10 years to do those acquisitions to be able to get there. Biggest thing that it took for me to learn, it was the hardest thing for me to comprehend and understand. If a property is paying for itself in terms of cash flow, I should be able to just continue buying, continue borrowing. But the banks do have their limits, and they do have a major factor into when you're doing your purchases. So really sort of plan ahead, guys, and understand, okay, well, it is going to take me 20 years to do these acquisitions, but I am going to get there eventually. It really comes down to the asset. And as you can see, with better performing assets, you're going to get better results. So it comes down to the asset. Understand you're only sort of doing 5 to 6 in the earlier scenarios purchases maximum. If you can achieve better results, we're only down to 3 purchases. So every purchase is super critical. Every purchase is going to impact your borrowing capacity. And it's probably one of the biggest factors that you should consider when you're building out your portfolio. But thanks for watching, guys. I hope you got a good understanding out of today, and one of my biggest learnings out of building a strategy for a portfolio. But hopefully I'll speak to you